On today's What Do We Do podcast, we're talking tariffs and what do they really mean for your investments. Trade policies can shake up the markets, impact industries, and create volatility. But smart investors know how to evaluate and navigate. And I'm here to tell you, what do we do? How can tariffs impact your portfolio? Which industries could be hit the hardest? And how do you position your investments for stability and growth? Don't let uncertainty and panic wreck your plan. In this week's episode, I'll break down how tariffs influence the market and what investors should do next. It's going to be a great show, so hit the subscribe button, give us a follow, and let's go. Hey everyone, welcome back to another episode of the What Do We Do podcast, your go-to show for financial strategies and market insights. I'm Dewey Stephan, CEO of Great Lakes Wealth, and today we're taking a dive into a hot topic that's making waves on the news channels, in the markets, and in the economy. Yes, tariffs and their impact on investing. Every time new tariffs are announced, we see headlines about trade wars, supply chain disruptions, and market volatility. But how do tariffs actually affect your portfolio? And more importantly, what should you as an investor do about it? Well, in this episode, I'll break down what do we do for you. We'll talk about what tariffs are and how they work, how they impact different industries, and strategies for protecting and positioning your investments. So let's jump right on in. And first, before we discuss investing strategies, let's define tariffs. What are tariffs and why do they matter? Well, simply put, a tariff is a tax. It's a tax imposed on imported goods. And governments use taxes for a few reasons. They use them to protect domestic industries, to generate revenue, and to pressure foreign governments in trade negotiations. I call it politics and protection. And you would think it's simple, right? Well, unfortunately, not so fast. The reality is that imposing tariffs can have ripple effects across the entire economy. We're seeing this now. It impacts businesses, consumers, and of course, investors. Well, here's an example for you. When the U.S. imposes tariffs on imported steel, domestic steel manufacturers benefit because foreign competition becomes more expensive. But industries that rely on steel, like the auto manufacturers, may see higher costs, which can reduce their profits and therefore impact their stock prices. Second, what's the impact on the economy? Who wins and who loses? Here's how tariffs can impact different industries. Let's break it down. The winners may include domestic producers in protected industries, maybe U.S. steel companies when steel tariffs are enacted. It could also be companies with limited global exposure, where less reliance on imports means less impact from tariffs, and certain commodities that may see price increases due to limited supply. Okay, now, who would be some of the losers? They may include companies that rely on imports. Examples here could be retailers, auto manufacturers, and even tech companies who source parts from overseas. Losers could also be the export-driven industries, as other countries impose retaliatory tariffs, which then make U.S. products more expensive abroad. And we, as consumers, who could face higher prices due to increased costs for our businesses. And these businesses will pass on those costs to us as consumers. And a simple example here could be the price of eggs. Have you seen them lately? Eggs are up about 50% just since the tariffs started. All right, bottom line, tariffs create winners and losers, but as investors, the key is knowing how to position your portfolio your way so you can minimize your risks and take advantage of potential opportunities your way. And as I like to say, volatility creates opportunity. And as always, please reach out to your financial professional to help you with your specific situation. And if you do need some help and don't have a financial professional, please feel free to reach out to our team at Great Lakes Wealth to see if we can help. Today, I'm giving you 3 strategies to consider. Number 1, diversify your investments across different sectors. For example, if tariffs impact a specific industry, like technology or manufacturing, maybe having a diversified portfolio, including other sectors like healthcare and utilities, will ensure you're not overly exposed to one sector. And since the tariff war has already started, know what sectors may have or will be affected the most. And if you think the tariff war will end soon, maybe consider adding, not selling, to those industries most affected so far. But if you think the tariff war is just beginning, then maybe evaluate your exposure to each industry you own to make sure the risks you face. Also, ETFs that track broad-based market indices can help hedge against sector-specific risks. Okay, number 2, focus on domestic growth stocks. I love this idea, but there is a lot of work that you'll need to do to find the best opportunities for your specific situation. Or, as I've said before, reach out to your financial professional, or perhaps reach out to us at Great Lakes Wealth to see if we can help. All right, companies with a strong domestic focus and minimal reliance on imports should be less affected by the tariffs. Maybe look for companies and businesses with solid US-based supply chains and pricing power, as this allows them to perhaps absorb the increase in costs. And number 3, keep an eye on what are normally boring investments like bonds and safe haven assets. This is easy to explain, as trade tensions often create increased market volatility, and we're seeing that now. And the reason may be because Wall Street hates uncertainty. So during these uncertain times with tariffs, some investors move into bonds, gold, or even defensive stocks like consumer staples and utilities. These assets could absolutely help balance the risk in a turbulent market. Case in point, as of the recording of this podcast, gold has just hit an all-time record high. And if the Fed decides to lower rates, this could positively impact the price of bonds too. Bottom line for today, and it is absolutely cliche, but it does come down to this: timing the market versus staying the course. Or, as we like to say, it is time in the market, not timing the market, that matters most. Now, one of the biggest mistakes that investors make during tariff announcements is overreacting. And with this current tariff war, markets absolutely dipped on the negative headlines. But history shows that trade tensions fluctuate and then settle in. And so do stock prices. So a strategy to deploy during a time when markets go up and down, up and down, up and down, would be what we call dollar cost averaging. So please look up DCA from prior What Do We Do episodes, but it basically means that you don't need to wait for and try and time the bottom of the pullback. You can find those investments that make sense for your personal long-term plan and buy a little bit at a time here and there over a longer period of time. So if the trade war may go on for the next 3 months, just buy a little bit of the investments you're looking at over the next 3 months. You can also refer to it as programmed nibbling here and there. So instead of trying to time the market, let's focus on long-term fundamentals and keep your eye on economic indicators too. We also say when the facts change, we can change our mind. So if new tariffs are introduced and the war continues, you should assess whether they truly impact the underlying value of your investment. And do this always before making drastic changes. All right, in closing, tariffs and trade policies may be unpredictable. However, successful investing is about staying informed and having a solid strategy. We like to say, make or evaluate your plan. Be proactive and pay attention. And we always say, if you fail to plan, you plan to fail. All right, well, here are a few next steps you should consider to fight the tariff war. Number 1, meet with an experienced financial professional to review your specific situation and make a plan for you. Number 2, review your portfolio and assess your tariff exposure. And how about look to capitalize on short-term market disconnects, which ultimately mean mispriced assets, ultimately for you to buy, not sell. 3, focus on long-term strategies, not short-term swings. Be patient and don't panic. And remember, a business or economic cycle has 4 distinct phases: expansion, peak, contraction or recession, and trough. So it's not about what happens in the economy or the markets in the short term. It's about how you prepare for it in the long term. With that, thanks for tuning in. And if you found this episode helpful, please make sure to like, comment, and even share with someone who could use this insight. Also, if you haven't yet subscribed to our channel, please do so, because as a community, together, everyone achieves more. Also, please feel free to visit greatlakeswealth.us for more information and to access all of our free resources. And you can also go to our website to schedule a personalized investment strategy review. Lastly, as I always say to wrap up the show, live your best life, be radically generous, a great big booyah to ya. And this has been another What Do We Do podcast episode, but we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.